Well, good afternoon, everybody, or good morning, depending where you are. Welcome to our webcast, Risk Analytics and Continuous Auditing, Experiences from the Field. It's a 30-minute webcast. You will have received the email notification a couple of days back. Mattel are unable to join us today due to unforeseen circumstances, but such is the life in risk and audit. Happy Valentine's Day. I'd like to introduce who your speakers are today. I'm Dan French. I'm CEO at Consider Solutions, where we focus on risk management and finance performance improvements. I'm in California, and my colleague Steve Rooney, who runs continuous monitoring practice, is in London. Today's topics we're going to talk through. We're going to just talk a little bit about the whole landscape for risk and assurance as we enter 2013, the relevance of risk analytics, and a very important element about the business case for doing this kind of activity. And I'm going to hand over to Steve to talk about the approach and examples from the field. And then we're going to come back on pitfalls and critical success factors and answer some of your questions, as many as we have time for. You can enter questions as you go through the webcast in the panel on the interface in front of you, and we will deal with those at the end. Those that we can't answer, we don't have time to answer, I should say, will be responded to directly by email afterwards. We also have some questions from you, though. So the first question for you, some polls. They're anonymous, but it allows us to get some aggregate feedback back to you. You can only put one single answer in. This is related to your role related to internal audit within your organization. Are you either the chief audit executive, a stakeholder or customer of internal audit, an internal audit team member, or some other role? So it should be very simple. 10 seconds to answer that. Single answer, please. Keep you awake as we have 4 polls as we go through this webcast. Okay, 5 seconds. Okay, let's have a quick look at the results. The results are so most of the majority, or the slight single largest group is internal audit team members. Okay, well that's good to know what company you're in. Okay, in terms of the risk assurance landscape, there's a very, very good report just out by the Institute of Internal Auditors, the IIA. It's called The Pulse of the Profession, a look at 2013. I do recommend you read that. It's a very good report. You can get it from the IIA. If you can't find it, let me know and I can get you, point you to it. But there's some very, very good, interesting results here. It's a survey of 545 chief audit executives and some interesting results, not least that the outlook for internal audit resourcing and focus is the strongest since 2008. So if anybody wanted a little bit of economic outlook, it looks like we are finally coming through some of the malaise that started in 2008. But I'm going to share 2 or 3 of the specific responses with you. And this one here is about expectations and plans for budgeting in 2013. And as you can see, a substantial proportion are looking at increased budgets for 2013, which I think has definitely not been true for every year since 2008. But more interesting than that is there's the increase in budget is not related to the increase in staff levels. So it shows something else is going on, and that partially relates to the topic of today. Organizations are looking to invest in things that really enable the people in internal audit rather than just add more resources, and some of that is about risk analytics. Another very interesting piece of the survey is the projected risk coverage for 2013. This pie chart, I think, tells an interesting story. There's a growing focus on operational risk, as you can see, that's 24%, and that reflects our experiences from work and observations we have. Although I think at one level, if you look at compliance, Sarbanes-Oxley, and financial general risk, which have a very close relationship, you can see collectively they're still a substantial chunk of the pie. But that's an interesting observation. And the other piece of the survey I wanted to share is to do with the skill sets that organizations are looking to hire. And as you'd expect, it's the soft skills at the top of the list: analytical thinking, critical thinking, and communication skills. That will always be up there at the top. But interestingly, the top skill in terms of technique is data mining and data analytics. And again, that reflects a growing focus that organizations are saying, we've got to stop talking about this and start doing it. So some interesting data points there. I do recommend you read the report. We've got one more poll for you. There's a lot of discussion about the role of internal audit, and a lot of organizations trying to get internal audit to develop more as a business partner. Now, there's some debate about this, not everyone agrees with it. So I'm interested in your perspectives. Again, single answer only. How do you rank your organization? Is it that internal audit are recognized as a valued business partner already? Or internal audit are striving to be a valued business partner? Or point 3, you don't want to be a business partner, it's not part of your mandate. 10 seconds for that, please. Should be fairly straightforward. Again, it's an interesting theme that's developing in lots of discussions. So 5 seconds. Let's have a quick look at the results. What do we have here? So, interesting. So the majority of people are striving to be a valued business partner. That's interesting. That does reflect what we're seeing. It's also interesting that there is a noticeable percentage of people who say that's not really our goal. That's 16%. So it's good to know, and I can understand the reasons for that. Okay, moving on. What are the relevance of risk analytics? Why is it relevant now and becoming more and more relevant? And I think it's very true that expectations from all stakeholders, internal and external to the organization, are rising fast. Visibility and transparency are the order of the day. Reputation is becoming more and more obviously the key asset. So when things go wrong, reputation takes years to build and doesn't take long to damage. But you add to that our organizations are more and more highly dependent on interconnected processes, systems, and organization units. We've got a lot of complexity, a lot of data, but the data does tell a story. And I think this is, again, one of the reasons, when you put all this together, this is one of the reasons why risk analytics are becoming such a focus point. You see this little image here. Many of you will have seen it before. The entrance to a car park, if you look very carefully in the middle, you'll see an electronic barrier which has needs your employee card to swipe through to allow you in. But the tire tracks in the snow tell you exactly what's going on in terms of risks occurring, and I think that's a lovely image to remind ourselves the data around those tire tracks exist, as well as the data around the car park barrier. So I think that's one of the reasons, the data point is one of the reasons why risk analytics is becoming so key, but ultimately expectations for visibility and transparency are accelerating. A very critical piece of the pie here in risk analytics is thinking about the business case. A lot of discussions around this, and obviously the business case depends on your organization's situation. Perhaps it's unsurprising that still a very significant percentage of these activities start as a result of perhaps bolting the stable door after the horse has bolted, in that there's been some risk audit event which has caused some embarrassment, perhaps a fraud event, and then management say, right, we've got to get better at fixing this stuff. And the business case in those cases is pretty straightforward and relatively simple. But more broadly, the objective typically falls into these 3 areas. The assuring reputation, we definitely see a lot of that, organizations wanting to be clear that they will get no surprises. Reducing the cost of audit is also up there, not just hiring more people, but using the high quality people we have to better effect. And also cost avoidance and cash recovery are another key objective. But when you build a business case, it's important to identify these 3 things. The direct benefits, which may be cash recovery, maybe cost savings, cost avoidance, effort savings, effort avoidance, all those direct pieces, as well as the soft benefits, which are related to the deeper, broader, more effective audit, changing the relationship of audit to the rest of the business. I think it's important to reflect on those. And also have some benchmarks that allow your stakeholders to understand the relationship of what you're trying to do with what's going on elsewhere in the industry. And there are plenty of those available. And obviously, there's people out there who can help you with business cases, but it is important that I think many organizations have trouble putting this together. The most critical piece, I think, is not to build a business case based on hope or what's just on industry benchmarks, but to do some kind of low-cost scoped pilot to validate what value exists for your organization and then work out whether a business case is relevant. Certainly what we're seeing is that's a much more powerful way of building the business case. So with that thought, I'm going to hand over now to Steve to talk to you a little bit about the approach and examples from the field. Steve.
Thanks, Dan, and hello, everybody. So as Dan said, I work as a practice leader at Consider Solutions, and I'm working with a range of companies in various countries and industries. helping them with their continuous monitoring and continuous auditing initiatives. And we've got just a few slides here to share a little of our approach to continuous monitoring, auditing, and exception analytics, and some experiences in this emerging area. First of all, I guess, how do we make this work, this approach? Now, many times the first thought is we need some technology, we need a tool. And clearly that is true at some point within the process. But equally, to make it a success, we need a structure, an approach, or what we've called here a methodology, to enable us to make this sustainable and repeatable. Different elements we've got here, and just adding some more detail to each one of these areas. But essentially, this is looking to address all of the different dimensions from a technology, from a process, from a people perspective. I'll just put out some of the key areas here. First of all, starting with the scope definition and the working out what areas and objectives are key within your business. And part of that is educating and informing the stakeholders and gaining commitment to the overall process, and continuing to nurture that commitment as things progress. From there, defining the risks and the analytics that are relevant within that context, and we'll see some examples of those shortly. Working out the end-to-end process. So yes, we're looking at the data, we're identifying some risks, but what other pieces are important such that we see the process through to its completion? And particularly important here is the review and action enablement. And sometimes that gets somewhat neglected. So we can identify the analytics, identify the risks, and produce the results. But if they're not being reviewed by the right parties within the business and actioned, then the value clearly is significantly reduced. Now, from an audit perspective, that typically is not our role. But equally, if we are using the analytics and providing the results, then it's key that we enable the people, the business units and parties there, such that they can understand what's being presented to them, and they understand what potential actions are needed to address the risks identified. Technology, clearly we need to set up the technology and make sure that is running correctly. And once we have those different pieces identified, we're then into executing on a business-as-usual basis. And again, key areas here are making sure that reviewing and actioning is taking place just by the reports or the alerts, the analytics identifying different areas taking place doesn't mean to say the review and action will take place. As we get into those review and action, then we expect some review and refinement of the analytics themselves. Now, moving on to potential areas of complexity. Now, we're not suggesting this is easy. There are complexities there that need to be understood. So in most larger companies, there are typically millions of transactions being executed across potentially many different systems. And so it's critical that we can understand those data sources where the transactions are captured sufficiently so that we can work out how to implement the analytics and how to navigate the data to be able to provide the information to the right organizational units, understand the process variables, understand any exclusions that we need to consider, so scenarios that should not be reported because they are acceptable. And then finally, enabling the reviewing and action to make sure that we see it through to the end of the process. So what to monitor? And this comes down to what is the focus areas within the business, what do audit and the senior management care about. And that can be focused perhaps somewhat on automating what you do today, perhaps in what you do today in a manual way, automating that, thus saving effort and cost. and could also be providing added value to the business, things that don't happen today, risks that are not being monitored, or a mix of be financially based risk, so where money is potentially leaking out of the company, perhaps due to fraud or corruption, or more operationally based, so due to inadequate or failing internal processes. So here's some examples we're showing here in different process areas. These are somewhat classic cases that hopefully most of you can identify with. And we're going to take 5 of these and drill down into a little more detail and discuss some of our experiences here. But a key thing in terms of choosing where you start is to look for the quick wins. So where is something within your business where there's specific ROI and it's of concern today. And look at those first, get some return, and that can then drive the commitment and drive the communications with other communities within the business. So let's take duplicate invoices and explore that a little more. So again, a classic case, essentially anything that can lead to a duplicate payment we're talking about here, clearly duplicate invoice being one of those things. And first of all, we need to understand how do we identify the risk when a duplicate invoice may be occurring. Clearly, we need to look at the invoice records that we have within our system. But also we need to work out how do we best communicate the exceptions when we find it, and how do we direct the exceptions to the right part of the business. So part of that is working out how we get the vendor details, and also the organizational unit details related to the invoice and the vendor, such that we can direct the results to the right community in the right way, such that they can effectively review and take action. The key point here is, in terms of information, you need to think about the overall context, not just identifying the exception. So moving more, some more detail in this particular scenario, again, duplicate invoices. In our experience, we are seeing duplicate invoices result for different reasons, and different criteria used to identify them depending on the how each company runs their invoice process. Some are more automated than others, and some the invoices are actually hard copy and sent into the company for processing and manually entered into the financial system. So in terms of criteria, we're typically looking for same supplier, same material, same value, same period, and also potentially the same invoice ID. What we've found are some duplicates are a result of manual errors, input errors. Seen lots where the supplier is waiting for payment and becoming impatient, so resending the same invoice, it gets entered again and potentially gets paid again. And some suppliers, we're seeing a pattern where particular suppliers may do that as a regular process, so repeatedly submitting the same invoice after a given period of time. What we're seeing is that there's significant amounts of money involved here, and therefore significant amounts of money unnecessary exiting the company. There are recovery firms helping with this process, but exception analytics can help companies directly identify these duplicates. And we're seeing this running into the millions of dollars annually at some of the companies we're working with. Let's take another example, a different area, fixed assets. So now, any corporate asset where there's some personal value, then there is a risk of inappropriate behavior occurring. Thoughts along the line of how can I acquire that asset for myself, potentially. If the asset is of zero value to the company, then theoretically no loss to the company if it is disposed of without cost. So this analytic is monitoring for the depreciation period of fixed assets. And one example we've given here is the company cars, where the statutory guideline is the cars should depreciate within a period of 4 to 5 years. However, we're finding in certain cases that that's being reduced. The example given here is depreciating in 1 year. So the company car is purchased, and within the first year, the value is depreciated to 0, and then the car is disposed of. Examples we've seen are this has happened many times, many instances of the company cars, and the value in excess of $1 million in a 3-year period. That's the total value of those cars depreciating within that 1-year period. Some other examples of assets there: machinery and equipment, buildings, office technology. We did find some strange things related to buildings. Haven't quite worked out the reason for that one yet, but somewhat interesting. Moving on to travel and expense, an increasing area where there's more focus. Now, misuse of expenses is typically not material, not significant from a financial perspective, relatively speaking. But from a reputational, cultural, even moral perspective, it's important that employers are only claiming legitimate expenses. As I say, recently there's been an increased focus in this area, and incidents of abuse have increased, and the values have actually increased in terms of what's being inappropriately claimed. And there's some examples there in the criteria of the kind of approaches, tactics that are being used. Duplicate expense items submitted, perhaps submitted first when it was incurred, but then a month later resubmitted in the hope that it can get through unnoticed. Particularly saw things like hotels and meals being reclaimed, claimed multiple times. Personal expenses for things that could be claimed as a regular business expense, but it's actually being used for personal use. So things like taxis, trains, and in those cases, the thing is to work out the criteria to identify that behavior. And also seen gifts as a common expense item. So the analytic would be using there would be looking for particular keywords that may identify these suspicious expenses. Just a couple of more examples. In sales, the price changes, and particularly what we're seeing is changes to prices after the order is created. And what we're seeing there is that that's being used to sometimes bypass the controls that are in place for the original order creation. It could be for discounting that may not be approved, or for some other reason. Maybe there's intermediaries involved, and we're trying not to expose those. In terms of what we found here, in one example, 16% of all orders within 1 month period had the price changed after the order was created. And another interesting factor, and coming back to Dan's illustration with the car park gate, a system control is typically you cannot create orders with 0 value, so placeholders. What we're seeing is very high numbers of sales orders where it's being created with a nominal value, a cent, 1 cent, 1 penny, and then subsequently being changed to the correct value. Now that's the tie track, effectively. We're working around the system control to get the placeholder in there, ultimately distorting the financial numbers. Lastly, non-standard payment terms on purchase orders. Now some people say to me, well, relative to other things, that's not particularly important. But it can be very, very significant. So again, in this case, what we're seeing is purchase orders created and then subsequently payment terms being modified. So originally created using the payment terms agreed with the vendor, and that typically covers the discount arrangement and the payment period, and then subsequently that being changed. And where it's of concern to the buying company is where the buying company has to pay earlier. So again, what we found here in one particular example, 8% of all purchase orders where the payment terms used are non-standard, so not the same as agreed with the vendor. Specific example where the payment period should be 30 days with a discount of 2%. subsequently changed to 10 days with the same discount model. So from a cash flow perspective, the more of those you have, the greater the impact. Okay, so just some examples there. So what's the significance? Why is this going to help? So just some top-line points here. One, it's looking at 100% of the data, of the transaction data is continuously monitored. It's not a sampling approach. It's not based on opinions. It's based on facts. We're looking at real data, the real transactions that are captured within your financial systems. The exceptions have a sharp focus. We're minimizing the noise. So we only report the things which are relevant and exclude those which may not need to be reviewed. Use the technology for what it's good for, taking care of the legwork, freeing the high-value audit resources for high-value work. And also we're seeing it as an enabler for becoming a more valued business partner, then exception analytics can play a key role. And with that, I'll hand back to Dan.
Thanks, Steve. That's an interesting set of examples there. We've got one more question for you. What's the status of risk analytics or exception analytics to monitor risk in your organization? Again, just one answer, please, 10 seconds. You have a well-embedded, mature model, emerging scope that you're programming, you've a plan for rollout, limited scope, early attempts, you're in planning, or it's not under consideration. 5 seconds, it should be fairly straightforward. Okay, let's have a look at the answers. Okay, 35% in first attempts, that's good. A lot of people in planning stage, and we have some very experienced people with us today. Excellent. Okay, well let's, Steve's talked about some of the value you can get and some of the examples, but what are the pitfalls and critical success factors? So the first thing I always think is, what can possibly go wrong? It sounds great. You think about this, and you can't go through a 30-minute presentation without a cartoon. And this is you've probably seen this before, but I like this. It's a classic case of managing a program. What can go wrong? So starting out with what your stakeholders expect and going through a series of changes to get up with what's eventually delivered. And the key point here clearly is to be clear at the outset what it is we're trying to achieve. And the things that can go wrong, apart from this kind of fairly tongue-in-cheek example, is a lack of business process understanding, a lack of risk understanding by the internal audit team can cause that kind of difficulty. Lack of understanding of data structures, the lack of ability to really design the analytics. And sometimes you see these situations where some of the analytics are really missing the point, which comes back to a lack of business understanding. So it's important all these things are there, which is why we need a balanced skill set. We talked about analytical critical thinking from the IIA report. This is what we need to be able to do effective risk analytics. We need that quality of thought, quality of communication. We need the business risk understanding. We need people who understand technical data structures and data filtering and data analysis. And you need people who can design the risk analytics with all of the complexity that Steve referred to. So that's kind of that's important. We deal with that. And critical success factors. I mean, here's a summary, but the key thing is this approach to risk analytics, continuous audit. It's an ongoing program. It's not a one-off implementation of a technique or a piece of software. It is getting more and more attention. So you will be finding stakeholders are asking you, why aren't we doing more of this? You want to be very clear. It's not a one-off thing. I do think all the evidence we have is when risk analytics are used to help enhance the business partnership as well as get a better assessment of risk. I think that's very powerful. Obviously, analyzing across the whole organization, across the 100% of the data, you're going to find these exceptions. You've got to be clear they're the right risks and the right exceptions. But with working with your stakeholders and chief audit executive, clearly managing these exceptions and dealing with them should already be a key focus for management. So that's a key point. Talked also about the combination of business risk skills and some exposure to technical data skills you need. However, it's it's not just about these things, also eyes. Our eyes remain important. There's a lovely Reuters article just last week focusing on fraud. It happened to be referring to fraud in China, but it could be anywhere. And it was a lovely quote about, you've got to remember, with all the technology and great repeatable methodologies, you've got to remember the Red Ferrari test. Our eyes still matter. When you're in the car park and see the fancy Ferrari, you just ask the question, well, whose is that, and how did that get paid for? Which I like. So final poll here for you. There's this one, you can have multiple answers. So for your organization, where do you perceive the value in exception analytics, risk analytics in your organization? Is it in cash recovery, cash saving, duplicate invoices and the like, effort reduction, effort avoidance, improved audit depth, scope and quality, which is a softer benefit, improving the business relationship, or some other? Now, you can, as I say, you can have multiple answers, so you have a few seconds for that. Okay, 5 seconds. Let's have a look at the results. Can we have a look at the results? Right. Ah, good. Okay, that's an interesting scope there. Well, we'll share these with you after the event. I'm conscious we're very close to the end here. Very interesting set of results there. So one point we said at the outset, how do you go through this process and actually build a business case? And we do think you need some way of proving a concept to help build a business case. Proving the concept with specific data points in your own organization. So some idea, we have something called a risk quick scan. There's other ways you can do this, but you want to take a scoped area and prove some value for a particular set of risks and use that at low, minimal cost to then build into a statement of value, whether it's worth building a business case to do this. Because you don't want to waste time if there's no value. So that's, so you want to consider that. Let's just look at what we've talked through. This is the agenda we've been through. I think we've got quite a few questions here. We've talked through the landscape, we've talked about the relevance of risk analytics, and touched on the business case a couple of times. Steve was very clear in the approach and examples. We talked a little bit about some of the pitfalls and skill sets and critical success factors. So just finally, we now have some questions. We really don't have much time. So if you haven't put your questions here on the panel, because we're going to respond to all of those by email, you can get to us at those email addresses. There's a blog there with some more information about this topic. I'll just deal with one of the questions here, which is, how do we get started without software investment? That makes sense, because I think people are concerned about that. So obviously, as Steve mentioned, at some point, you're going to need to use some analytics tool. But there's a number of things you need to do first, and I'd certainly suggest some sort of work to validate which of your risks represent a good match for automated analysis, for risk analytics. Perhaps a point-in-time assessment like that quick scan, or perhaps even just getting a smart auditor with an IT background to write some SQL scripting to validate this case for action. I think that's a good point. A couple of other interesting questions about whether this work should be undertaken by management, not internal audit. That's a bigger question. I think we have completed our 30 minutes. I apologize, we've come to a rather rapid stop there. We focused on 30 minutes, but it's best use of your time and everybody's time. Respectful of that. Thank you very much for your attendance. We will come back to your questions directly by email. If you have any others, please come to us with those email addresses. And thank you very much for your attention and enjoy the rest of your day.